Hi folks, welcome to this recording which allows you to practice the preparation of consolidated financial statements when there are intercompany sales over and above just that of dividends. So we're looking here at intercompany sales and any intercompany transactions between the parent and the sub. So in this question what we have is a requirement to prepare consolidated statement of changes in equity. Now I know for some people they haven't perhaps done a statement of changes in equity, so I'm just going to flash up a little bit of what it might look like once it's completed. So what we would have here is it kind of looks like a statement of changes for each of the equity accounts. So we can see in our problem we have common shares, retained earnings that would have a consolidated balance as well, NCI, and then the total. So we would start with the balances for each of these accounts, each of the consolidated balances at the beginning of the year. We would also add income, and the reason is income doesn't affect the value of common shares on your books, but it does affect retained earnings, right? And it is also going to affect NCI because NCI gets its share of the sub's adjusted income. And dividends are also going to affect retained earnings because, again, we're going to be looking at any dividends that were declared by the parent to its shareholders to adjust the retained earnings column. And for NCI, we know that when the subsidiary company declares dividends, the parent gets its share, but the NCI is also going to get its share, which is going to reduce your obligation as the parent company to the NCI shareholders. And then we're going to come up with, that should probably just say ending balances at December 31st. For common shares, retained earnings, NCI, and then our total. So this is kind of what ours is going to look like when it's finished. Okay, so now let's do the first thing we need to do, which is we need to first calculate if there's any goodwill, and to do that we need to know what the acquisition differential is. If there's any acquisition differential that we haven't allocated, that's your goodwill. So we're going to look at the cost of 80% of the investment that the parent made and leased at this date. And we also know that the implied value of 100% is going to be $2 million. Now don't forget why we look at 100% of the investment here. We know that the parent company most controls with only 80%, but they control 100% of the company. So we're going to calculate the value of the investment, or its implied value, at 100%. Now, what does the parent gets for its investment in leased? Well, it gets the assets less liabilities of the company, which is basically the common shares plus the retained earnings of leased at the date they became related. We can see that the total book value of the company, or carrying value of the company, is $1.5 million. But they didn't pay $1.5 million for it. We actually now have an acquisition differential in comparison to the value they control and the book value that they've got of $500,000. So there must be a reason for this additional $500,000. So why did we pay more? Well, first of all, the accounts receivable, if we compare the carrying value to the book value, or to the fair value, we can see that the receivables, we as most think they're worth $20,000 less than the company's booked them at. So that's like a decrement of $20,000. When we compare the inventory, we think that the inventory was worth $600,000 as the parent company most, but the carrying value is $650,000, so there's a decrement there. The plant and equipment, though, at net, the lease, the sub, has the plant and equipment at $2,015,000. We think the fair value is somewhat higher, $35,000 higher, at $2,050,000. So that's our increment, right? We also think that the long-term liabilities are worth less. So in other words, we have the subleased booking the liabilities at $1.2 million, but we don't think they're that much. We think they're $1.1 million. So we've got a decrement, which is actually a good thing for the parent company. So it's like an increment, right? Because it means the liability is less, and they're buying a lesser liability than what the sub has got it booked at of $100,000. So at net, we have increment of $65,000. So if we compare that to the reason we paid, we have $500,000 more than we got in carrying value, we can see that the difference, the unallocated acquisition differential, because we've allocated 65 right here, right? We've got goodwill of 435,000. The next thing we need to do in order to prepare the statement of changes in equity is we need to figure out how much of the acquisition differential gets amortized over the time period from the date we became related to the end of the current period. We need to know that, right? So in other words, when we look at that, we need to look at years 3 to year 9 in total. So what we're going to do here, because that's going to adjust your retained earnings, right, during the year. So we're most interested now in looking at this column here to adjust our retained earnings. This is years 3 to 8. And we're interested in looking at year 9 separately because year 9 acquisition differential amortizations will adjust the subs income. So now if we have a look, we know that at the date we became related, this decrement here of 20,000 would have definitely been amortized between years 3 and 8. Why? Because by that time the receivables would have been turned over, right? So they would no longer be there. Similarly with the other current asset inventory. Now plant and equipment is different because the plant and equipment is going to be amortized over the remaining useful life of the plant and equipment assets. And according to our question, they tell you that's going to happen for a remaining 8 years from the date of acquisition. So if we took 35,000 and divided it by 8, we get 43.75 per year. We have to multiply that now by 6 years. Year 3, 4, 5, 6, 7, and 8. That's 6 years. So 43.75 times 6 means that we've been amortizing for 6 years. So that's 43.75 times 6 is going to give us 26,250 over that period. The long-term liability, because it matured at January 1, year 7, that increment would have been fully amortized. So that would have been fully amortized by the time we extinguish that debt, or the sub-extinguish the debt. So that 100,000 would have been amortized in this time period. So of the original 500,000 in acquisition differential, we've allocated 108,450 to years 3 to 8, 13,075 to year 9. How do we know? Because the question told us that throughout the period of time that we recognized the goodwill, they told us that goodwill impairment tests resulted in losses of 52,200 in year 4, which falls into this period, and 8,700 in year 9. So we know that in the year 9 period, we would have had acquisition differential amortizations plus an impairment loss, which total 13,075. So of this original 500,000, we've amortized 108,450, amortized and had an impairment loss of 13,075, leaving us with an unamortized acquisition differential of 378,475. So now, why is this significant? This amount is going to be used to adjust the subs income this year in order for us to calculate consolidated net income. This amount here is going to help us calculate the opening balance of consolidated retained earnings for year 9. Why is that important? Well, you remember here we said if we're going to do a consolidated statement of changes in equity, we're going to need to know for retained earnings the opening balance of consolidated retained earnings for the year. So therefore, we know that when we use the separate entity retained earnings to start, we know that the subs retained earnings is going to be impacted by the acquisition differentials that we amortized from the date we became related to the end of year 8, which is like the beginning of year 9. So we're going to be using this number again. This is a really important schedule because it helps us to do so many things. Calculate consolidated net income, calculate the parent's share of the sub's post-acquisition retained earnings of the sub up to the beginning of the current year for which we're doing consolidated statements, and we're going to use the unamortized acquisition differential to help us calculate the opening balance for NCI on the consolidated statement of changes in equity, because again, we need that number for here, right? NCI at the beginning of the year. So we're going to need that number here. So all of those numbers are important for us. We know from the question that we do have intercompany revenues and expenses for sales and purchases. They told us this year, for sales and purchases. Let me just adjust this here. Okay. We know that during the current year that intercompany sales were $2 million and $1.5 million. We get the $2 million from the additional information, and it told us that during year 9, $2 million of most sales were to leased. So this is what most sold intercompany to leased, and this is what leased sold intercompany to most. That's the 1.5 million. So in total we have 3.5 million in intercompany sales. Now, what we want to do here is we want to do a closer analysis of the intercompany profits that are sitting in ending inventory. What I'm going to do, instead of dealing with the land first, I'm going to start to deal with the inventory accounts first. And you know, everybody's going to have a different way of doing these schedules. This is one of the ways that some of the suggested solutions that I've posted in your course do it. But again, it's up to you guys how you want to rationalize it. But I'm going to start, first of all, I'm not going to start with the land. I'm going to treat the land separately. I'm going to look at inventory. So why am I looking here? Well, first of all, I like to separate these out by looking at opening inventory profit. So any profit sitting on inventory that's either sitting in most inventory or leased inventory at the beginning of year 9 that hasn't yet been sold outside to third parties. And I also like to separate that from the ending inventory. That's looking at any ending inventory that's left that was sold intercompany by most to least or least to most, doesn't matter, but because it hasn't been sold outside to third parties, then any profit that's sitting in that ending inventory has to be removed. So therefore, let's look at these separately. Let's look first of all at opening inventory here and see where we're getting our data from. Well, if we look at the additional information, let's look at opening inventory most selling. You can see there that there's a piece of information there that talks about, in your textbook, it talks about the December 31st year 8 inventories of leased contained 312,500 of merchandise purchased from most. So that means that leased has inventory that it bought from most of that amount. That's the dollar value or what they paid for it. But we also know that when most sold to leased, it priced its inventory at a 20% profit. So in other words, it priced the sale to include 20% profit. So we know that the before tax profit sitting in this opening inventory, which is the ending inventory at year 8, but it's the opening for the current year, which is year 9, because don't forget year 9 is the year you're doing the statements for. So this is opening at the beginning of year 9, which is ending year 8. That means we have profit in there of 62,500. But don't forget, there's tax at 40% on that. Question tells us we're using a 40% tax rate, and that's 25,000, which means after tax you have 37,500. Why is that important? Well, because this 25,000 in tax, that $25,000 in tax here is going to have to be recognized this year in year 9 as increased income tax expense. The reason why is because if this was profit that was sitting in the opening inventory, by the time you got to the end of year 9, which is the year for which we're doing consolidated statements, that means that this profit was realized. because this amount, even though at the beginning of year 9 it wasn't yet sold outside, during year 9 it was sold outside. So therefore, this profit is going to come into consolidated income in year 9, and we're going to have to increase our tax expense for the year for the consolidated entity by $25,000. So this is on an after-tax basis going to increase income and therefore retained earnings by $37,500. Now, we're also going to see here that from the additional information, we also know that leased, the sub, sold inventory in year 8 to most. And when leased was selling, they told us that most was unable to unload or sell to third parties $857,140, of which 30% represents profit, because we know when lease sells to most, it sells at a 30% profit. So therefore, the profit sitting in this ending inventory, in most ending inventory, is going to be $257,142. At a 40% tax rate, we know that profit attracts tax of $102,857, which is going to impact this year our income for $154,285. Now, how do we, our income, but also our retained earnings, right? So what does this mean? Again, because it's an adjustment to opening inventory, which is the beginning inventory of year 9, which is the same as the ending inventory for year 8, this means that this amount here would be taken into income before tax in year 9. Why? Because this is intercompany profit that's sitting in opening inventory for year 9. But by the time we get to the end of year 9, which is the year for which we're doing statements, all right, that inventory would have been sold. So this profit would be taken into income. It would attract tax of $102,857. So that's another amount by which we're going to have to increase income tax expense on the consolidated statements, and this would also adjust our retained earnings this year by that amount. So these amounts are going to adjust retained earnings for the year, and we'll see how when we start to do the statements. Now, we also have to look at the impact that intercompany transactions would have that occurred during year 9. So in other words, any intercompany sales between most and leased in year 9. And we know that when most sold to leased, leased had from the current year 9 sale $500,000 less. At a 20% profit, which is what most charges leased, that means that there's $100,000 in profit sitting in income this year. Now again, we say income because it's ending inventory, which relates to sales in year 9. And we're going to be looking at income in year 9. This $100,000 is before tax profit that's sitting in most income for year 9. But what do we know? That's profit that it really can't take into income this year because it's related to items that least has not yet been able to sell outside to third parties. So that means we're going to have to reduce income tax expense this year by $40,000 because most book that profit of $100,000 when it's sold to leased. So when most was selling to lease this year in year 9, most legitimately booked that profit in its separate entity income. But from a consolidated perspective, the consolidated entity can't book that profit because leased has not been able to unload $500,000 of inventory, of which this $100,000 is profit in this $500,000. So therefore, if it can't book the profit, it can't recognize the income tax expense that they booked on that profit as well, they being most, because most was the seller. So therefore, we're going to have to adjust most's income this year by $60,000 or reduce it, because leased hasn't been able to sell that that inventory that's packing this $60,000 after tax profit. Okay, so we have to adjust the income of most downwards. Similarly with leased, when leased was selling, they booked profit before tax of $214,284, which is sitting in the intercompany inventory, which is sitting in most inventory because leased was selling. So the question tells us that there's $714,280 that most hasn't yet unloaded of what it bought from leased, and that has profit of 30% because lease charges 30% profit on that. So there's $214,284 sitting in most inventory, which represents profit. Now, we are going to have to, if we can't recognize that profit in the consolidated statements because most hasn't yet sold it outside to its customers, then therefore we also can't take in the income tax expense into the consolidated income tax expense account this year. So we're going to be adjusting income tax expense downward, and we're also going to be adjusting consolidated net income downward. So how is this going to work? Well, this amount here, this $125,714, represents taxes that most has paid and least has paid. So the consolidated entity considers this $125,714 as deferred taxes. Taxes that the consolidated entity can set up as an asset, because from the consolidated perspective, they're saying, well, the two separate entities have paid taxes, but the consolidated entity can't recognize those as taxes on the consolidated statements this year. So to the consolidated entity, it represents prepaid assets, prepaid taxes. So we're going to see that this is a deferred income tax asset. All right. This has to be eliminated because this is profit that's sitting in the inventory that was sold intercompany, and so we're going to have to make adjustments in total of $60,000 plus $128,570 to the separate entity income of most and least here in order to calculate the correct amount for consolidated net income. All right, and again down here it tells us that we've got deferred taxes and ending inventory of this amount. And again, a deferred tax is nothing more than a prepaid amount of income tax. But because the consolidated entity can't take in the income taxes because they can't take in the profit this year because it hasn't yet been sold to outside entities, then they consider that a prepaid asset or deferred taxes. So now, before we go into the calculation, or first of all, I guess I should just say that there were some intercompany dividends that were declared but not paid by the sub, and the sub paid out or declared $100,000 in dividends, but they hadn't yet paid them out. 80% went to the parent. So again, there's $80,000 in intercompany dividends that most the parent company has in its income this year that we have to remove or adjust most income for in year 9 because it's intercompany. So before we look at the calculation of consolidated retained earnings for January 1st, year 9, I just want to calculate consolidated net income for year 9. I just want to make sure that you're comfortable with that calculation. So let's do this calculation. We'll do this calculation because we are coming up to 15 minutes on this video. So I think what we'll do is we will come back to this in the second video. So stay tuned for part 2.